Hey everyone, welcome to episode 4 in my series where I review my favorite fund managers who have funds designed for us passive income focused investors. This is episode 4 where I will cover Hamilton ETFs. If you missed any of my previous episodes, make sure to check them out. I group these videos in a specific playlist so they're very easy to find. So Hamilton ETFs is a newer ETF manager in Canada who really specializes in the financial sector, but they also manage two of my favorite ETFs of all time right now, HYLD and HDIV, which I usually call all-in-one covered call ETFs. So they named their company after Alexander Hamilton, who needs no introduction. He's one of the founding fathers of the United States, the very first Secretary of the Treasury. He was essentially the founder and chief architect of the American financial system and has the honor of being on the American $10 bill. So Hamilton ETFs is one of the fastest growing ETF providers here in Canada with over 1.5 billion in AUM or assets under management. And they currently manage 9 ETFs total. 7 are pure financial ETFs. And then of course, the 2 other ones are the covered call, the all-in-one covered call solution. So in this video, I will review and go over all of Hamilton's ETFs. I'll focus a little bit more on the funds that I really like and own myself, but I'll also review their other ETFs as well. So let's get to it. All right, everyone, I am on Hamilton ETF's website. Whenever you're doing any research whatsoever on any funds, always go to the official fund manager's website. I know I said every video, but I will keep saying it. So here is the homepage. I'm on the homepage right here. And as you can see from the mission of Hamilton ETFs, it's the helping Canadian investors and financial advisors get more out of the financials portion of their portfolio. I mean, you have it right here, right? Financial sector specialists. So let's go through the ETFs one by one. Here is the list. We'll go through them and we'll start with the multi-sector ETFs, which are basically the 2 all-in-one covered call ETFs, which I love dearly. So we'll start with HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF. This is the first one. It's been out for almost a year now, I believe, and it's done extremely well. So basically this ETF is tracking or trying to track broadly the S&P TSX 60. So basically that it's trying to mimic a little bit the Canadian stock market. So if we scroll down, you have all the information that we need. The first thing we always have to look at is what's inside the fund. So you have the sector breakdown here, but here you have the holdings. So this ETF holds 7 other ETFs, basically with 7 other covered call ETFs that is each with their own sector. So you have, you could pretty much get an idea of the sector just by the name. So you have HEP, which is the Horizons Enhanced Income Gold Producer ETF, NXF, the Energy Giants Covered Call ETF, ZWU, the BMO Covered Call Utilities, HHL, the Healthcare, FLI, the US and Canada Life Co, ZWB, very popular Canadian Big Banks ETF, and then HTA for technology. So each ETF is from a different provider. You have 2 from CI, 2 from Harvest, 2 from BMO. These are leaders in Canada when it comes to sector-based covered call ETFs, are some of the best. So this one here, HEB, takes care of all your gold producers, very defensive, basically material sector. So things like Barrick Gold, Newmont, etc. NXF is your energy giants. It says giants because it's the biggest oil and gas producers in the world. So Suncor, Canadian Natural, the 2 big ones from Canada. You have Chevron, BP, all the biggest, really, Shell is there. So, really the ExxonMobil, really the big oil and gas producers. ZWU will take care of all your utilities exposure in North America. So things like Bell, TELUS, Rogers, AT&T, Verizon for your telecom. Whenever you see utilities, there's going to be electricity companies, telecom companies, and also some pipelines. So the telecom companies I just mentioned, the electricity companies, you have Fortis in there, Emera, and you have a bunch from the US. You also have Enbridge and TRP and Pembina Pipeline. HHL is my favorite healthcare cover call ETF managed by Harvest. It's their biggest ETF, by the way. So you have all the 20 biggest healthcare companies out there like Johnson and Johnson, AstraZeneca, Pfizer, et cetera, et cetera. So that this will take care of your healthcare. FLIs for life insurance companies. So you have Sun Life, Manulife, Great West Life in Canada, and another 7 in the US, MetLife, Prudential, etc. ZWB got your 6 big banks with covered calls, and HTA will take care of your technology companies, so Apple, Microsoft, Cisco, etc., etc. So assets under management, this fund has grown. It's came out in July 19th 2021, so it's not even a year yet, and it's almost at 200 million AUM, which is really, really good. The yield, I think it's a little bit higher than that, but it typically varies between 8 and 9%. And really, really awesome fund here. I consider this an all-in-one covered call ETF solution because it simply holds 7 of the best sector-based covered call ETFs. And basically what they're showing with this index is that they wanted to create a covered call ETF that kind of follows what the overall Canadian market does. So that's why, it has the gold, it has the energy, utilities, the 6 banks. So it's trying to mimic it. But in my opinion, it's actually better because of the added diversification. You have the tech ETF and the healthcare ETF. And as we know, healthcare and technology is very underrepresented in the Canadian market. And this graph just shows that the index that this ETF HDIV is based on times 1.25. That's because of the leverage. So what makes this ETF special, by the way, is because it uses 25% leverage. So this is actually borrowed money. It's a loan facility. It's not like a split share fund where it's synthetic leverage. So and as we know, institutional margin or institutional borrowed money is very, very, very cheap. So even with rising interest rates, I've been getting a lot of questions about this. How will it impact Hamilton's leverage? Well, the answer is very, very, very little. And I'll actually be talking to Rob Wessel about it shortly. So stay tuned for a video. So this graph is very interesting because basically what it's showing is that this index that the ETF is based on. So basically you could say that this ETF is beating the overall Canadian market. Whenever you see S&P TSX Composite or TSX 60, it's kind of like the S&P 500 for the Canadian market. So it measures the entire Canadian market. And as you can see clearly from the graph, if you would compare both of these, starting in July 2015, HDIV will beat the overall Canadian market. Not really a surprise. So HDIV, one of my favorites for sure, a real game changer for us income investors. And they recently came out with their US version. I absolutely love this one. Very, very high yield, over 11%. It's the Hamilton Enhanced US Covered Call ETF. So just like HDIV, it also has a collection of covered call ETFs and also uses 25% leverage. But instead of trying to mimic the Canadian market, this is more tailored to mimic the US market. So the index that they're comparing it to is the almighty king of kings of benchmark indexes, the S&P 500. So it's neck and neck with that fund here, as you could see, which is very, very hard, first of all, for a covered call solution to actually beat the S&P 500. So this just says it all, and that's where that leverage really, really plays a nice part. So if we look at what 7 ETFs this ETF or all-in-one ETF holds, there is some overlap. So you do have HEP, which was already in HDIV, HHL, which was already in HDIV as well. So you got your gold producers, you got your healthcare, you also have another harvest ETF called the brand leader. So in here you have a lot of the best brands in the world, things like McDonald's and Pepsi and Apple and JP Morgan and Chase, or I think it was Morgan Stanley, Caterpillar, UPS. So really the most powerful US brand companies. You also have TXF, which is pure technology. So this would compare to the HTA covered call ETF that's in HDIV, but in HCAL they put TXF, which is from CI, which is a little bit higher yield. So in here you have your pure technology. So this is 4 of them. And what I really like about this one is, in my opinion, they have the 3 best covered call ETFs on the US market, which is QYLD, RYLD, and XYLD, which follow indexes. So XYLD is literally the S&P 500 with covered calls. QYLD is the NASDAQ 100 with covered calls. So it's very tech focused. And then you have the RYLD, which I'm a big fan of, the Russell 2000 index. So this is an index that tracks the 2000 of the smaller to medium-sized companies in the US. So I say it all the time on my channel, and I keep saying it. You have QYLD, RYLD, XYLD. It's kind of like having the whole entire stock market with covered calls. So you're maximizing your monthly yield, and the yield doesn't lie, right? 11% here. Assets, AUM is very quickly, getting to HDIV's level. It's at 118 million. I think it's probably going to beat HDIV. Eventually, just because the U.S. market's a lot bigger, a lot more popular than the Canadian market. So this would, is really a really excellent ETF to get the whole exposure to the US market in terms of covered call, in terms of maximizing income. So if we actually look at the distributions, this ETF came out just a few months ago, and there was already a little increase in the monthly dividend, which is really, really excellent, really attunes to the high income that this ETF could give. And by the way, I forgot to mention, if we go on HDIV, it also had a bump in the distribution starting in March of 2022. So it went from 11.11 cents here to 12.5 cents. So really, really nice increase in dividends as well on HDIV. So it's very surprised to me. I didn't think that these two ETFs would be able to increase the dividend, but they both did. So I really, really love these two ETFs. They're pretty much the cornerstone of my portfolio. You guys know this already. But I don't want to take away from the other great ETFs that Hamilton has, including the number one performing Canadian bank ETFs. That's right, HCAL. In terms of performance, so when we say performance, we're talking about total return, guys. It beats ZEB, it beats ZWB. The two, the covered call one is ZWB from BMO. ZEB is the equal weight one. So HCAL, what makes it special is that, and why it has enhanced as well, is because like HYLD and HDIV, it also uses 25% leverage to boost the yield and the performance of the portfolio, which is the top six Canadian banks. On top of that, they use a mean reversion strategy, which means that if we look at the overview, you could actually see it right here. So they own the six banks, but they put the majority of the asset allocation to the three banks that are recently underperforming to get more exposure there, so you have more growth potential. And they allocate a little smaller percentage to the three banks that have been overperforming. So basically, it's a good way to even boost it even more. It's more efficient than having it equal weight, and that's basically what we're just finding the index here. I think that's in the HCA. So HCA is basically the same thing as HCAL without the 25% leverage. So if you actually look at HCAL and look what's inside of it, it literally has HCA, right? It's the Hamilton Canadian Bank Mean Reversion Index ETF. The only difference is that HCAL uses 25% leverage. Very, very big, by the way. It's 370 million AUM, very nice yield, and also has, of course, increasing dividends, right? So if the Canadian banks increase their dividends, keep in mind that HCAL there's no covered calls on here, so you will capture organically the growing dividends of the Canadian bank. So HCAL is really, really amazing. It basically holds HCA, which is also from Hamilton. It has the mean reversion strategy, but without the leverage. So if you love the strategy, you don't want the leverage, you could go for HCA, completely fine. But I would always stick with HCAL if you want maximum total return off the banks. And here's the graph that I wanted to look for. So basically, what this is saying is that the mean reversion strategy in red beats if you would just hold the Canadian banks equal weighted. So the average compound total return since inception, since 1990, would be 16.4 with the mean reversion, and you would have 14.2 without it. So obviously, the mean reversion wins, and it's much better than just owning the banks equal weighted. So once again, you could see the top three underperforming banks have the biggest percentage, and the ones that are performing really well have the small one. So this also is a really, really big fund. And once again, HCAL literally is HCA, but with 25% leverage. That's why you're getting a nice 6.14% yield instead of the 4.68. And I'm happy to announce also that they recently came out. This is their newest ETF, the Hamilton Enhanced Canadian Financials ETF. So whenever you see an enhanced, get ready for some nice 25% leverage. So this is the case again. So HFIN is basically a sister fund of HCAL. except instead of having only the Canadian banks, it also has other Canadian financials like life insurance and some asset managers. So let's check it out. So obviously you have the big six Canadian banks, right? TD, BNS, Royal, National Bank, etc., BMO, etc. But it also has the big life insurance companies. So Manulife, Great West Life, Intact Financial, Sun Life, and it also has some really big asset managers like Brookfield Asset Management, and also Power Corporation of Canada, which of course we know that they own Great West Life and Investors Group. So they have some asset managers in here. So this is equal weighted. You could see here. So if you want something a little bit more broad than just the Canadian banks, obviously the Canadian banks make 50% of this, so it's a big chunk. But if you want something a little bit more diversified in terms of, financials in Canada, HFIN is a great new option that you have a really, really nice yield. Very close to HCAL's yield, except you have a little bit more diversification. So those are really my favorite ETFs from Hamilton. They also have some other great options. They also have another four, and my favorite out of the remaining four is really the Australian banks one, HBA. So Australia's economy very close to or very similar to the Canadian economy, and their banks are also managed very similarly. So in Australia, you have 5 banks that really have the complete control of the banking industry. And so this ETF has, on an equal weighted basis, index based, the 5 Australian banks. So a really cool way to get exposure to the Australian banks, which I think, just like the Canadian banks, are very, very safe and well managed. You'll get a nice yield of 5%. No leverage on this one, however. And this graph shows that really, if you're comparing the Australian banks to the Canadian banks, the Australian banks actually outperformed them by a little bit. So that just shows you how powerful that oligopoly is. Right here, I love that word, oligopoly. Yeah, hard to pronounce, but basically the big 5 banks that control Australia, or that are really big in Australia. So cool way to get exposure to them. Very, very easy, very simple. You have it with one ETF, HBA. And Hamilton also has 3 actively managed. So all the ETFs we saw so far are passively managed, but they also have 3 actively managed ETFs. You have a financials innovation one, which is basically a fintech ETF. And, the fintech stocks haven't been doing really well, but believe it or not, HFT, this ETF, is the number one best performing fintech ETF ever. So that just goes to show that Hamilton ETFs are really your financial sector experts. And if you look at the holdings, I don't recognize a lot of the companies. I recognize some like PayPal and Visa, but a lot of them I don't recognize. So these are more fintech companies. So they're disruptors in the financial space. So this is an actively managed fund. Doesn't have much yield here, but this is really designed for growth. So if ever you want a fintech ETF, I strongly suggest getting HFT. It's the best performing one. They also have HUM, which is the US mid and small cap financials, so the smaller and medium sized financial companies in the US. So another really a growth focused ETF here, and this is actually the number one best performing financials ETF. So yeah, the trend is clear for your financials. Go with Hamilton ETFs. They know what they're doing. So in here, you'll have probably a lot of companies I won't recognize. These are smaller to medium-sized financials companies in the US. So it's an actively managed fund, 1.62% yield, but a great way if you really want to capture the smaller to medium-sized financial companies in the US. More growth focused, that's for sure. Last but not least, they have the Hamilton Global Financials ETF. So just like the name says, global. So you have a collection of the best global financial companies. So really good not sector diversification, because it's all financials, but regional diversification. And you could see it here, the breakdown here. So you have nice chunk in Europe, you have Asia, Australia, 40% in the US, and 13% in Canada. So a cool ETF if you want to capture all the best financial companies around the world. No leverage, no covered calls. HFG is probably a good fit. And of course, keep in mind that this is, once again, a growth oriented ETF over a yield oriented ETF like the first 4 that we saw. So that's it for Hamilton ETFs. Really, really cool financial focused ETFs. And of course, the 2 amazing covered call all-in-one solutions, HDIV and HYLD, which, by the way, while I'm filming this, the press release just came out today that they're putting a vote. They're basically want to change the objectives of HDIV and HYLD. So basically, they want to detach themselves from the index that the funds are based on, I believe. So I'm going to get more information on this from Rob Wessel, and so stay tuned for an upcoming video on it. But I think it's a good thing. This announcement basically means that the fund manager is going to have a little bit more say, a little bit more active management on HDIV and HYLD in terms of, you know, rebalancing it. So I think it's good news because it'll probably be able to take advantage of, you know, what's happening in the market. So a little bit more on that coming up in an updated video, probably in the next couple of weeks. So there you have it, everyone. Hamilton ETF's fund lineup. So there you have it, everyone. Hamilton ETFs. Like many of you know, I absolutely love HDIV and HYLD. These ETFs are really a dream come true for buy and hold long-term investors who wish to really maximize their monthly income in the safest way possible. So you literally have really high yields thanks to leverage and covered calls, but safety as well thanks to diversification, right? So these ETFs literally have the same income enhancing characteristics of split corporations or split share funds, but without the risk of missing dividends since they don't have that split share structure, right? So they also have the #1 best performing big Canadian banks ETF, like we saw, HCAL. So if you're looking for maximum total return off the Canadian banks, HCAL is your #1 choice for sure. They beat ZEB, ZWB, and all their competitors, and even owning the banks yourself individually, right? So that's because of that leverage and that mean inversion strategy. Absolutely genius. Also, they just came out with a brand new one, a sister fund to HCAL, which also has a little bit of leverage. HFIN, like we just saw, which is it really captures the entire Canadian financial. So it has the banks, but it also has some life insurance and some asset management companies in there. So if you want a little bit more broader financials diversification instead of just the banks, HFIN is probably your best bet right now. Also has a nice yield thanks to the leverage. No covered calls on those, so it's really designed for maximum total return. So it's more of a dividend growth strategy, not a pure income strategy. But if that's what you're looking for, those two ETFs, I highly suggest them. And also the Australian banks one, I really like it. It's the Australian economy is very mimics the Canadian economy in structure, and the banks as well. They have a very good reputation, so it's a great way to capture the Australian banks who that have been doing really well. So I got a bunch of other videos on specific Hamilton ETF funds like HYLD and HDIV, etc. So make sure to check out my other videos. I also interview Rob Wessel numerous times, so I'll put those videos in the video description below so you can check them out. And that's it. Thank you so much for watching, guys. I really appreciate it. Please show your appreciation by hitting that like button. It helps the channel grow. It's free for you. It's a win-win. It takes 2 seconds. I would really appreciate it. Also, consider subscribing if you like this type of content. My channel is all about investing for maximum passive income. So please subscribe. Hit that little bell button as well so you're notified whenever a new video comes out. You don't want to miss my upcoming content. And of course, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase and sign up for my digital product, the ultimate DIY investing package, which is on version 3 right now. So I'm very proud of this product. I'm very proud of this package. It comes with lifetime updates, so you only have to buy it once. And when you do, you will have all the next updates for free. And I do plan on making version 4, coming out with version 4 in Q3 of 2022. So that package will help you invest on your own. Basically, it has lists of funds, ETFs, closed-end funds, split funds, as well as a lot of sample portfolios. I have sample portfolios for Canadians and Americans, and tailored to different investing needs, not just income like I do, but also growth, also dividend. There's low risk income, aggressive income. So it's a very cool product to really help you build your own portfolio. That's really what it's designed for. So make sure to pick it up if you haven't already purchased it. And of course, there's also a bunch of free tools and resources on my website at the top right, free tools and resources. And right there on the homepage, I do offer a one-on-one consultation service with yours truly. So if ever you want really more personalized help, you could book a one-on-one with me. We'll have a 1-hour Zoom call. I'll go over your existing portfolio. I'll help you transition to an income portfolio. I'll answer all your questions, whatever your needs are. I really love helping people out, and my appointments do sell out very, very quickly. I apologize. I can't do more than 4 a week because I need time to do the content, to publish more content, of course. So just look at the little message on top of the calendar right there on the homepage to get a status of the appointments. Usually I will open up the appointments for the next month on the 25th of each month. So stay tuned for that. And also, if you want to join our community, we have a Facebook group with over 10,000 members now. Passive Income Investing, that's the name of the Facebook group. So if you like this sort of content, I strongly suggest you join the Facebook group. We monitor it very closely for spam, so it's very, very clean, and everyone shares their ideas and shows their portfolio and the income they're making every month. It's very, very exciting that the community is growing. So make sure to join us on Facebook. We're also on Instagram. So Instagram, make sure to follow us if you want a little bit more personal content on our life, including our move to Panama. So if you want a little bit more personalized content to us, you could always follow us on Instagram. So the mission of this channel, my mission, will never change. It will always be the same, everyone. It's to help everyday, normal, regular people invest on their own, to do it yourself investing, so they could build their own stream of passive income and enhance their quality of life and eventually become financially free, financially independent like us. So with that, take care, guys. Make sure to stay healthy, stay safe, and of course, stay passive. See you next time.